Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with StickyTrades, and this is the chart of the DIA, which is the Dow Jones Industrial Average ETF. We're coming into the close. We're in the final 2 minutes of the trading day, and as I zoom in here, you can see that little red candle is known as a hanging man. That is bearish, and that hanging man is showing up right at this role reversal resistance area. Now, last week I talked about the role reversal. I highlighted that in every one of the ETFs. And I believe that that resistance area will hold next week. I think we're coming right back down. Remember what I said in the midweek report? I think we're stuck in this range. So next week, I think we're coming right back down. Eventually by next Friday, I'm going to leave this in here because this was the target from last week. I think we're going right back down to that very same number of 379.61. Now, if you look at the CCI, that is in an overbought condition right there. Overbought meaning overvalued. You could look at that as overextended. Those are all synonymous when looking at the market. And I just want to point something out because this is not investor buying coming in. Look what happened right before the market opened. You see all this activity in here. This gray area is pre-market activity. We saw the futures going up right before the numbers came out at 8:30. We saw the continued push. There's the closing bell right there, 4 o'clock on Friday, May 3rd. We saw the continued push on the opening, and then we basically sat here in this sideways range for the rest of the day. The same thing happened with IWM. You could see, again, the big push right before the opening. Very few investors are going to get involved in pre-market activity. So this is institutional buying that came in. I'm very suspicious about that because the numbers came out. You had inflation coming in a little bit higher. And so that was all negative news that came out at 8:30 this morning. So for the most part, fundamentally, this doesn't make any sense to see the market up as much as we are seeing it today. So I think next week we're going to come right back down. Let me give you the numbers on the daily chart for IWM. You see that all the markets gapped up, by the way. So this gap from back here is going to act as resistance as well. And I think we're coming right back in. Now, for IWM, I think we're coming right back to the moving average. Might get a little bit of an ABCD zigzag and then right back down to this level. So I'm going to give you two downside targets. First downside target is going to be 198.95. Then I think we'll see a pivot at point B, then a pivot lower at C, which will bring us eventually down to 194.59. Again, look at the CCI, how overextended that is. So IWM is now caught between two gaps, a gap to the upside and a gap to the downside. Click on the link in the description box that brings you to my gap trading strategies so you'll know how that works. 80% of the time gaps fill, then after they fill 80% of the time prices reverse from the gap fill point. So again, I think we're going lower next week. Taking a look at QQQ, it's going to be the same scenario here. I do believe that we're stuck right here. There's another hanging man at the role reversal resistance line. Again, former support, once broken right here, turns to resistance. CCI is extremely overbought. Let me show you what number that looks. That's 146.11. Anything over 100 is considered to be overbought. Now you can see the ABCD zigzag here. I think we're going right back down. We'll pivot lower, then we'll see a B up to a C and then a lower D. Again, stuck right in this range right here for the Qs. So the swing traders are perfectly positioned as the markets oscillate between this range, especially for the option traders who consider themselves to be swing traders. Option traders buy and sell options on these short trading legs and make money from a couple of ways. We make money from delta, positive and negative, and we make money from time decay through different strategies. So if you're interested in learning about how to trade options, just come on over to Sticky Trades. We have an online course that you can take for options and start you off at the most basic level and move on from there. All right, so that downside target is going to be 425.73. Even though we hit that last week from last week's market report, I'm going to reestablish that again as a downside target of 425.73. I said on Wednesday that we can go a little bit lower. We did that yesterday, but we didn't hit that downside all the way. But I'm keeping this downside target right there again at 425.73. Looking at SPY, same thing. We gapped up. And we bumped our heads against this resistance, which again is role reversal. Now we have a gap below the market. Oscillators here, especially the CCI, is overbought. I think that's going to hinge lower and we'll be stuck in that range. So again, downside target, even though we hit it last week, I think we're going right back down to 501.22. No need to change that. Now what did change just a bit is the VIX. Look what happened. We dropped. Absolutely, we dropped. And there is an open gap below the market on the VIX, but that will most likely act as a support. If the VIX moves lower on Monday and fills that gap, there's now a 100% chance that the VIX will move back up, which again, remembering that for the most part, the VIX is inversely related to the S&P. So if we bounce off of the support level and eventually get up here to my 1838 target, that will be bearish for the S&P. Let me show you some of the economic news I was referring to right here. This is forexfactory.com. The link to this website is in the description box below. You see the unemployment rate, they forecasted 3.8, it came in 3.9. Now notice how Forex Factory color codes these numbers in red. Why? Because that is negative for the market. You could click on this little file folder there and it explains to you how this is interpreted. And historically, when you see that drop, that is bearish for the market. So if the actual is less than forecast, it's good for the currency, but it came in higher. You see, not much, but it came in higher. So the market should have sold off. It did not. Again, I think the institutions are doing whatever they can to hold this market up until they could sell into it. As we go through the charts, please understand that I use my 7-point trading checklist. This is what I give to all of our members. If you're not yet a member, you could set up a free membership on our website. Just go to StickyTrades.com, set up your free membership, and you could download this 7-point trading checklist, print it out, and then use it for your own technical analysis. Looking at the banking sector, you can see that the regulators came in and shut down First Republic, and this is the first bank failure of 2024. Like I said before, this is the dominoes going down, and you can see JP Morgan, Chase, and Bank of America suffer another $4.5 billion in losses as they describe this as unrecoverable debt, and that's soaring because they're still invested in long-term bonds. Taking a look at the IMF, what are they doing? They're sounding the alarm over our debt. This came out through government spending, published on April 18th. You could Google that, and you could read the entire article, what they're talking about with regard to how dangerous this is. Not just for the U.S. economy, but for the world markets as well. When you look at that debt, you could see that every child born this year is being born into $82,590 of debt. They didn't ask for this. The parents didn't ask for this. They didn't go to the bank and take a loan out for $82,590. How are they going to pay that off? That's being paid off in taxes. By the time these newborns are reaching age 18, that debt soars to $143,964, and you can see how that climbs over time. Our debt is out of control. Something absolutely has to give, and you can see the numbers that the Chicago Purchasing Managers Index is screaming stagflation, something that no one on the airwaves is going to want to talk about. They don't even want to use the R word for a recession, let alone the S word. But all of the data is pointing to stagflation. What is stagflation? It's when you have inflation combined with a recession. That's the worst kind. That's what we saw in the Jimmy Carter days. And if you look to see what's happening over at the Gallup polls, an open-ended question was asked: what is the most important financial problem facing your family today? And they found that the trend in this being mentioned in that open-ended question is going up. And the answer is high cost of living and inflation. And look at how consumers are stressing out over this. This is a Gallup poll that was taken. So when you look at inflation numbers and how tame they are, and you see how nice and comfy the Fed is, and how they're talking about how they're going to get this under control and inflation is going to get down to 2%. That's a big fat lie, folks. Everyone knows it, and you're going to see that the consumers are being stressed out. When people are concerned, especially families, are concerned about the high costs of living and inflation, what do? They cut back on their spending. And what's going to happen eventually, companies suffer, earnings suffer, the market suffers. And so when I tell people, watch out below, I am talking about the markets going into a crash like we've never seen before. Remember, last week I talked about the moving averages crossing. Look what's happening right now. SPY, the 20-period moving average, has crossed below the green line, which is the 50-period moving average. And what are we seeing? We're seeing an exact duplicate of what happened back in August of 2023. And you can see once that moving average is crossed, we saw a little bit of a rally and then the downturn. This is exactly what we're seeing today, maybe on Monday, but overall, I think by the end of next week, we're coming right back down and we're going to see this whole area duplicate. That's my opinion based on the technical analysis. So nothing to fear. If you're positioned for the downside, especially using options, you're going to be in great shape. Now, I want to go back to my regular weekly market report charts right here using the diamonds. And I want to talk a little bit about Fibonacci retracements, right? What is Fibonacci retracements? Well, Leonardo Fibonacci, who is a mathematician, came up and discovered what's called the golden ratio. It's a sequence that starts with 0 and 1, and the way you progress in the sequence is you take the two previous numbers, add those together, and it gives you the next number in the sequence. So 0 and 1 equals 1. And then 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5, and you go on in the sequence. Well, as you progress in the sequence, the ratio between these numbers remain constant, and you have the golden ratio. What does that mean? Well, look what we see here when I use my Fibonacci retracement tool to calculate where the pullback point could be calculated using this high to this low. So when you're looking for a bounce or a target to the upside after the market is sold off, you take your calculator, you click on the high, bring it all the way down to the low, and where does that bring you? Well, look what happened here. Today we pulled back to the 50% retracement level, which is 387.66. The 50% retracement level is my favorite pullback point, and from here, now that we've reached that, I think we're going right back down. So if you want to fool around with your Fibonacci calculator, now you know how to do it. On the way down, you go from the top to the bottom. On the way up, if you're looking for a pullback point down, looking at this leg right here, watch what happens if I take that low and bring it up to this high. Where does that bring you? Right to the Fibonacci retracement line right there. So fool around with that tool. It's a lot of fun. You can practice, and I tell people all the time, look at 20 stocks a day and practice your technical analysis forecasting. If you look at 20 a day and you write down your targets over time, I tell people it's not going to be very hard for you to get a 70% hit rate on your forecasting. Again, stick with Sticky Trades. Go to the Sticky Trade University. We'll teach you how to do this. And you have a great weekend. Thank you so much for liking, subscribing, and commenting. I love your comments. I'd like to know how you're doing with the Fibonacci calculator. If you have any questions about that, type it in the comments page. I read every single comment. I don't get to comment on everyone, but I read every single one, and I'll do my very best to help you out if you have a question. Again, thank you, and have a great weekend. So long.